Welcome. In this video, Zbcn coin can increase by 60%. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
The presence of a bearish order block at the current price level is a highly critical situation from a technical analysis perspective and should be closely monitored. These types of structures are typically defined as areas where significant selling occurred in the past, and it is quite likely for the price to struggle or even get rejected in these regions. A bearish order block usually represents a strong supply zone, meaning large players, whales, or institutional investors may have placed sell orders there. If those orders are still valid, the price could face renewed selling pressure upon reaching this area. For this reason, it's often not easy for price to break through such blocks on the first attempt. At this point, the fact that the price is currently within or just below a bearish order block serves as a serious warning signal for investors. Because when the price reached this area in the past, selling pressure may have increased, leading to a downward move. This causes many traders who follow technical analysis to keep a close eye on this zone. Bearish order blocks tend to be especially effective during periods of low liquidity or when the market is weak. In these scenarios, the existing sell orders in the area act as a ceiling, preventing the price from moving higher. In other words, these levels function like invisible walls, making it difficult for the price to break above. Many traders closely analyze how price behaves when it reaches such blocks. If the price is quickly rejected upon reaching the level, it indicates that the sell orders in the area are still active and strong. This tells us one thing: it may not be realistic to expect the price to break through on the first attempt. On the contrary, price may test this level multiple times, sometimes fluctuating briefly within the block. During these tests, the way price reacts is very important. If each time the price responds with stronger upward moves, it means the bearish order block is weakening and the price may eventually break through. However, it's quite natural for there to be a rejection on the initial touch. This rejection can sometimes result in a sharp move downward or appear as a more subtle pullback. Especially if the price has made a fast and steep climb before reaching this area, the impact of the bearish order block is felt more strongly. That's because rapid rallies are often followed by profit-taking, which increases the strength of the existing bearish order block. Therefore, investors should be cautious in such areas, use stop losses, and pay close attention to the structures that price forms within the block. That said, these types of order blocks are also strong resistance levels, and breaking above them usually provides very positive technical signals. But to determine whether the breakout is real, one should not focus solely on short-term wicks, but on candle closes. For example, daily or weekly candle closes above the block indicates that the price has truly broken through the level and turned it into support. This significantly increases the likelihood of the uptrend continuing. On the other hand, if there are only wick-like moves above the block, but the candle closes remain below it, it signals that the breakout has failed and the block is still active. Additionally, psychological factors come into play here. Since many investors familiar with technical analysis are aware of these blocks, just the approach of the price to this level often triggers sell orders automatically. This can sometimes cause a reaction before the price even reaches the core of the block. For this reason, it's not only the numerical aspect of the price action in these areas that matters, but also what it means in terms of investor psychology. It must be remembered that every order block can eventually be broken. The key is understanding when and under what conditions that break occurs. Factors such as market volume, momentum, overall trend direction, news flow, and investor sentiment all play a role here. For instance, if the general market sentiment is positive, Bitcoin is in an uptrend, and confidence in altcoins is rising, then even a minor news item or technical signal may lead to a breakout of such blocks. Conversely, if fear dominates the market, investors are cautious, and Bitcoin is in a downtrend, these blocks may act like an unbreakable wall. However, we can't rely on the order block alone to make analytical decisions. Let's take a look at other metrics as well. Stay tuned.
The MACD indicator is a highly effective technical analysis tool, particularly for measuring the direction and momentum of a trend. The two main lines within this indicator, the MACD line and the signal line, provide valuable insight into market strength, direction, and potential reversals. When both the MACD line and the signal line begin to move upward, this typically generates a strong signal that price action may also gain positive momentum. This suggests that the price is gaining upward momentum and that buyers are entering the market. Now, let's examine this in more detail. The MACD lines are calculated by taking the difference between two exponential moving averages, EMAs, usually the 12-day EMA and the 26-day EMA, to form the MACD line. A 9-day EMA of this MACD line is then used as the signal line. Crossovers between these two lines generate positive or negative signals in the market. However, it's not just the crossovers that are important. The direction of the lines themselves is also a crucial part of the analysis. An upward movement in the MACD lines indicates that the 12-day EMA is pulling further above the 26-day EMA. This is a significant sign that the market is gaining momentum and prices are moving upward with strength. When the MACD lines rise, it reflects increased buying pressure, strengthening long positions, and this pressure positively impacts the price. This upward movement is also clearly visible in the MACD histogram. When the histogram bars begin to grow above the zero line, it indicates strong buying pressure and a strengthening upward trend. So not only the crossover, but also the upward slope of the lines and the expansion of histogram bars in the positive region serve as key indicators of a potential price rally. Investors and technical analysts often interpret an upward movement in the MACD lines as a buy signal. This signal becomes even more meaningful when it occurs while prices are bouncing off a key support level. For example, if the price makes an upward move from a significant support zone and the MACD lines simultaneously begin to rise, the combination of these two signals provides stronger confirmation. This boosts investor confidence and encourages long positions. The rise of the MACD lines also reflects the strength of the trend. Many traders focus not only on price increases, but also on the strength behind the move. In this context, a rising MACD line suggests that the price is not just experiencing a temporary increase, but is supported by strong momentum. This growing momentum indicates the potential for prices to continue rising and shows that the trend is not yet exhausted. Moreover, if the MACD line stays above the signal line while both are rising, this is considered a highly positive development. It signals a safe uptrend to investors. Even if there are minor pullbacks, this structure suggests the overall upward trend is likely to continue. On price charts, this is often seen as a sign of healthy trend continuation. The upward movement of the MACD lines is often supported by volume as well. When price is rising and trading volume increases while MACD lines also point upward, it becomes a much stronger bullish signal. This indicates that many investors are taking positions in the same direction, showing strong confidence in the upward move. As a result, it suggests the price is entering a longer-term bullish trend rather than just a temporary bounce. Some investors may view rising MACD lines as a short-term signal, but when interpreted correctly, the indicator can also signal the beginning of medium to long-term trends, especially when the MACD lines, after remaining low for a long time, break upward. It may indicate that prices are poised to move significantly higher. Such patterns often mark the beginning of a trend reversal and provide early entry opportunities for investors. The upward movement of the MACD lines also psychologically influences investor behavior. Because these indicators visually represent rising momentum on the charts, many traders respond with positive sentiment when they see such signals. This often triggers new buying activity in the market. As more buyers enter, prices face additional upward pressure and the bullish trend strengthens. In this way, the initial technical signal from the indicator is further reinforced by the reactions of market participants. In many cases, when MACD lines start to rise, the uptrend does not occur abruptly. It progresses in a gradual and healthy structure. This gives investors confidence, as sharp and sudden rallies often carry correction risks. However, the balanced and steady rise in MACD lines indicates that prices are also appreciating in a gradual manner. This creates a relatively safer setup for long-term investors.
In conclusion, when the MACD indicator lines show an upward trend, it is a highly reliable technical signal that price movement is gaining positive momentum and that there is strong buying pressure in the market. The upward direction of these lines indicates the strength of the trend, increasing momentum, and the continued healthy rise in prices. Especially when combined with other technical indicators and support resistance zones, this setup offers strong and reliable buying opportunities for investors. Therefore, the rise of MACD lines should be considered not only technically, but also as a highly positive and supportive signal in terms of investor psychology and market structure. If the lines rise, the price will rise.
The flag pattern is a highly important and closely monitored structure in technical analysis, typically representing a brief consolidation phase following a strong price movement. This consolidation phase forms a visual pattern on the chart resembling a triangle or a flag, hence the name flag pattern. As a continuation pattern, investors pay close attention to whether the price breaks out upward or downward from this formation. In this context, the price appears to be forming such a flag pattern, and if the upper boundary of the formation is broken upward with strong volume, it could signal a sharp and rapid rally. In technical analysis literature, when a flag pattern breaks, the price target is often projected to be equal to the length of the flagpole, the height of the sharp move preceding the flag. Accordingly, if this flag structure breaks to the upside, a 60% price increase is anticipated in the current scenario. Such formations typically appear in the midst of a strong trend, meaning they occur as a continuation of a rally. If the price has previously risen sharply and steeply and then begins to move sideways or slightly downward for a short period, this could be the flag-forming process. This structure indicates to the investor the price has digested the previous rise and is now ready for another upward push. The key point here is that price movements within the flag should form a narrowing structure. That is, highs and lows get closer together, the price consolidates into a triangle, and this tight range typically resolves with a breakout. If the breakout occurs to the upside, the pattern is confirmed as bullish. From a technical standpoint, the current structure, with the price moving within a flag, can be explained by buyers holding the price up and sellers failing to maintain consistent pressure. This suggests a temporary balance between supply and demand, with market participants waiting to determine direction. However, once the upper boundary of the flag is broken, this balance shifts, favoring demand. As a result, the price may surge upward quickly. The projected 60% increase is calculated by adding the height of the previous sharp move, the flagpole, to the breakout point. These kinds of formations often occur when large investors are increasing their positions without triggering market panic. The flag structure allows big players to accumulate during sideways price movement. Later, a strong breakout can be initiated, rapidly pushing the price toward the target. For investors, these formations are valuable because they provide both a clear breakout point and a measurable target. Stop-loss levels can also be placed below the lower boundary of the flag, helping to minimize risk. As such, flag patterns are highly useful for both technical analysts and short-term traders. Additionally, an upward breakout from this pattern also signals that overall market momentum is positive. This typically occurs during times when market sentiment is optimistic, news flow is favorable, or risk appetite is elevated. A decrease in volume during the formation of the flag, followed by a sudden volume increase at the breakout, confirms the validity and reliability of the pattern. Therefore, investors should pay attention not only to price action, but also to volume dynamics. Especially when there is a specific target like a 60% increase, it's important to check whether this target is supported by fundamental analysis. In other words, is this purely a technical move, or is it backed by underlying developments? If the breakout coincides with positive news or sectoral developments, the likelihood of reaching the target increases significantly. For this reason, investors should consider both the chart pattern and the broader macro environment. Another important factor is the time frame of the pattern. If the flag is visible on a larger time frame, its impact tends to be stronger and longer lasting. Technical formations that occur on larger time frames are usually monitored by a broader group of investors and tend to have a more lasting effect. Additionally, such setups can also serve as buy or sell signals for large institutional investors. Therefore, a flag breakout on a daily or weekly chart can truly signal a powerful rally, making the 60% target not a fantasy, but a realistic outcome. In some cases, these flag patterns can be part of much longer-term trends. Short-term consolidations within long-term uptrends indicate that the trend is merely taking a breather, not losing momentum. For this reason, flag patterns are considered one of the strongest signals for trend continuation. If the flag breaks to the upside, it is a strong sign that the trend remains alive and well. This may encourage investors to take bolder positions.
In summary, a potential 60% increase following an upward breakout from a flag pattern is a logical and consistent expectation, not only from a technical analysis standpoint, but also in terms of market psychology and investor behavior. Factors such as the structure of the formation, volume at the time of the breakout, overall market conditions, time frame, and support from fundamental analysis all influence whether the target will be reached. However, when all these factors align, an upward breakout from such a pattern can indeed trigger a significant price movement. Therefore, flag patterns should be taken seriously in technical analysis, with breakouts assessed in conjunction with volume and targets calculated objectively based on the pattern structure. A clear and strong target like 60% offers investors a major strategic planning and risk management advantage.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.